Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. We want now to look at a simulation. We see how we can be able to go through the different aspects that we need as far as computation of work is concerned. In the previous video, we looked at the impact of taxation on our cost of capital, and we highlighted few things that we need to take care of as we are computing the work. So let's now look at a simulation. It's basically about work computation. A UK company can use this. A UK company is financed by 7 million £1 ordinary shares and £8 £8 million 8% redeemable debenture. The market price, the market values are £1.2 ex-div and £90 per £100 ex-div, per £100 ex-int respectively. Meaning for the debentures, it's the par value is 100, but the market value is 90. The debenture is, the par value is £1, but the market value is £1.2. They are continuing that a debenture, a dividend of £10 has just been paid, and future dividends are expected to grow by 5%. So the debentures are redeemable at par in 5 years time. 5 years time. Have the required. They are telling us that if taxation is 30%, calculate the weighted average cost of capital. The weighted average cost of capital, or what we call WACC. So that's our question. So let's now try to look at the solution. So we can first give the WACC formula as VE over VE plus VD times KE plus VD over VD plus VE times KD 1 minus T, which is the tax rate, meaning we are going to adjust for tax. Now, if you look at this question, taxes are not in arrears, because basically if you look at the question, it says a UK company, it's a UK company, so it's not in arrears, because most of the times the Ugandan companies, they are the ones that pay in arrears, but since it is an international company, we don't expect them to not to let them pay now, and we expect them that maybe they will pay in the next year. So for those, most of the time before they transfer the profit they have made to their mother countries or to their mother businesses, they are supposed to first pay the tax. So we can assume that the taxes are paid in the same period. But if it was a Ugandan company, or if the question was looking at a Ugandan company, then we would assume that taxes are paid in arrears because the examiner did not specify. So here we can assume, because most of the times that's what we basically do here in Uganda. So we look at what we basically take into consideration. So now we start by looking at the formula. We have already stated our formula. We now want to compute the cost of equity, because I told you one of the hard thing is for you to be able to compute the cost of equity, that is KE, by first knowing which formula, which method that you are going to be using. But according to the information they gave to us, we are basically going to use Gordon model, because they were talking about a dividend of £10 has just been declared. It has just been declared, meaning it is a current dividend. They have also given us the growth in dividend. So the question is about dividend that has been paid. So the examiner will never put all the information for all the methods. He will just give you one direction about which method that you are going to follow. But we know that Gordon model, if you are using KE to get, if you are using Gordon model, is D naught into 1 plus G over MPS, but we say this MPS must be X div plus G. So our D naught, of course, our D naught we said we have already seen, D naught is £10. Then of course our G, the growth rate, they told us it is 5%. Then the market price for this ordinary share, they told us it is £1.2. So we just substitute into the formula, then we get the cost of equity. So it is going to be, because this one is 10 into 1 plus 0.05 over the 1.2, of course, plus the 0.05. So once you have that, you will see that this one is going to be, because this one is going to be 5%, 10.5. So it is 10.5 divided by 1.2 plus the 0.05. You will see that it will give us 8.8%. So we can take it to be 9%. Our KE is 9%. Now, we have a debenture. They have given us a debenture, but this debenture is redeemable, which means that we are going to be looking for IRR. But since we have a tax, it's supposed to be adjusted for tax. So we go through the same way. So we can start with years. Of course, here I'm not going to put the one for details. So I'm just going to start with the cash flows. Then I put the discount factor, then the present value. But since we are doing two NPVs, so I'm just going to make it in one table. So DCF, again DCF. This is for the second NPV. DCF, then present value. So we are going to start filling in the values that we have. So we start from year 0. We are investing at market value. The market value was 90. 1.0. Here we pick any rate. So I'm going to use here 10%. I'm going to use 10%. So when I use the 10%, now we are going to use annuity factors. We are not going to go by the other way we went last time. We are pushing up to the fifth year. There are 5 years, so each year we are going to be getting interest of 5.6. Then we look at what is the discount, the annuity factor. 10% fifth year is going to be 3.791. 3.791. So we have also to redeem at the end of the fifth year. So in the fifth year we are redeeming, but they told us we are redeeming at par, which is 100. So this is a present value because we are receiving this, we are redeeming once. So it is going to be the discount factor 10%, 50 period is 0.621. So multiply. When you multiply this times this is going to give you 62.1. Then you multiply 5.6 times the 3.791. It's going to give you 21.23. So this one is 90. We first compute our first NPV. Our first NPV, of course, we add this plus this, we take off this one. So it is giving us a negative NPV of 6.67. Remember that we assumed that the taxes are going to be in the same year, meaning we don't have any problem with the way we have arranged it. But if it was in areas, then it would be a different scenario. So we proceed. Now we go to the second NPV. So we have seen, we have gotten a negative NPV. What do we do to the rate? Once we get a negative NPV, then we reduce the rate. So here we are going to take maybe, let's take 5%. We have reduced to 5. When you get a positive NPV, you just increase so that you can be able to get a negative. But here we have a negative, so we have to reduce the rate so that we can be able to get a positive NPV. So this 5%, this is 1.00. Of course, the annuity factor 5% in the fifth year is 4.329. Then of course the present value, now this is a present value factor, 5% in the fifth year, which is 0.781. So when you multiply this 100 times this, it is going to give you 78.1. Then this one is going to give you 24.24. This one is 90, but it's a negative. So we get also the second NPV, which is 12.64. It is a positive. If you choose a lower rate and it doesn't give you a negative, it doesn't give you that positive NPV, then you have to try again because it's a try and error. So this installment that I've used here, the one you are seeing me using here, the interest, we need to first, they gave us the coupon interest. The coupon interest was 8%, but the par value was 100. So the interest or the cash flow was supposed to be 8% times 100, and this is going to give you 8 shillings. No, it's a pound, 8 pound. These were pounds. I want to explain why I took the other one instead of this. So this is 8 pounds. Now, I used the other approach of first adjusting the cash flow for taxes. So I adjusted this cash flow, 8 pounds into 1 minus the tax rate, which was 0, which is 30%, that is 0.3. So this is going to give you 5.6. So this 5.6 is what I used the other side as the cash flow, and adjusted it for tax. Otherwise, if you never wanted to adjust it for tax, you would go by this 8%, then the answer you get is the one that you should adjust for the tax. But here I've just adjusted the coupon interest. So that means when I go to the other side, when I get the IRR, I will not adjust it again for tax because the cash flow was already adjusted for tax. So remember, we said when you are investing, you always invest in year 0, and we always invest at market price. So you look for the market price of the venture. It's the one that you are going to be using to invest in year 0. We always invest in year 0 because we expect that once we invest in year 0, we expect to be receiving coupon interest in the first year or in year 1. That's why we are investing in year 0. Otherwise, for you to earn something, you must have done the investment. So since here we are just doing the investment at the same time, we have to assume that we must have invested maybe in year 0. So that's the assumption. So we go to the IRR. We go to the IRR. We've said it is A plus capital A over capital A minus capital B into B minus A. You may find that some people may be writing A plus A over A plus B into B minus A. Reason is because this B you are seeing here is always a negative. So once you add this, it becomes the positive, but the formula remains as the other one. So let's now put in the values. The lower rate is 5% plus the 12.64 over 12.64. Of course, this is a minus. It is going to be a plus 6.67 into 10% minus 5%. So once you work out all that, it's going to give you 8.3%. And that's how we'll be able to compute the cost of that debenture. We now need to look at the market values because we need to know the market value for VE and then the VD. So VD, of course, we said that they have given us 8. The VD is 8 million. That's the book value over the par value. The par value is 100 times what is the market value is 90. Because they told us it is trading at a discount. Actually, the par value is 100, but for it, the market value is at 90, meaning it is currently trading at a discount. So once you do the computation, you'll find that you'll be getting 7.2. These are pounds. The formula is the same. You get the book value of the debt or of the debenture divided by the par value. You multiply by the market price of that debenture or bond. So here the book value was 8 million. The par value was 100. So we go to the VE, that is the cost of equity. The book value was 7 million divided by the par value was 1 times the market. What is the market? The market is 1.2. So this means that we have 8.4 million pounds. So now we need to compute our Wacc. So we compute the Wacc, and we said Wacc, it was VE, which is 8.4, over VE, which is 8.4, plus, I'm going to first take off these zeros, because it will not fit. It might not fit. Let me maybe try to write it in small letters, because if I take off the three zeros, you may get confused, because we have some percentages. So this is 8 plus 7.2 times what is the cost of, we had gotten our cost of equity as 9% plus the 7.2 over 7.2 plus the 8.4. Of course, times this one we have already taken into consideration the tax, which is 8.3. So we see what answer are we getting from there. Times the 0.09. So this is giving us 0.049 plus this is 0.038. So once we add that to 0.049, it will give you 0.087. Of course, if you convert it to a percent, it will be 8.7%, and this is going to be your Wacc. So if the cash flows that they have given to you, because sometimes in the question they may give you the cash flows, of which those cash flows may be a little bit post-tax. You may find that when the cash flows they have given to you, they have already adjusted for tax. If they give you post-tax, then there is no need to, of course, post-tax means it is after tax. So if they give you cash flows that are post-tax, then you just don't take into consideration the tax, component because we have already adjusted it. So if the examiner doesn't give you the current market price, what will you do for the debentures? And you find maybe there is no data for you to actually be able to compute, because you may find when the data available is not, you can't use it to be able to compute the market value for debentures. So we just consider we just take the par value to be the marketing value, because it can happen. So that's basically what I wanted to talk about. So in the next video, we are going to be looking at the cost of convertible debt. Convertible debt. We need to be able to know if at all the debt can be converted into equity. How are we going to be able to get the cost of that kind of instrument? So that's what we are going to look at in the next video.